What if I told you that you could save $5,000, $10,000, $15,000, or even more this year without living on bread and water? Stick around, because I am about to share with you the most practical 5-step blueprint for saving money in the time it takes to drink your morning coffee. Step 1. Analyze your outgoings. Making a start is always the hardest step. However, once you do, you will feel so much better and life will become a lot easier. Download or print your bank and credit card statements with 3 months' worth of outgoings. Hey, you can even write them down using quill and ink. Okay, maybe that would take too much time. What can you cut? What do you need to keep? Are you using your Netflix, Disney Plus, and Apple TV Plus subscriptions? Is there a gym that you haven't visited in a year? Are you subscribing to a magazine with unread editions piling up like the Leaning Tower of Pisa in your living room? Embrace cancel culture and cut out the chaff from your life. Audit all recurring payments. Take a look at the direct debit and standing order sections of your bank account. If you need them all, great. If you don't, you could save a small fortune in unused or unwanted products and services. For the items you don't cancel, could you switch to an annual rather than monthly fee? Often subscription services and products provide a 10 to 20% discount when you switch to annual payments. It's a saving that can really add up. And speaking of savings, this leads us to the next step. Step 2. Analyze debt interest rates. Congratulations, you've started your more money monthly journey. Let me tell you a secret. Step 2 is where you can really make some savings. Personal debt, whether it's loans, credit cards, or mortgages, is a vibrant, ever-changing industry. Part of the ever-changing nature is the variety of interest rates that apply depending on the timing of when you take out the product. As in Step 1, you can analyze the payments you are currently making towards debt on your 3 months of bank and credit card transactions that you previously downloaded or printed. The next part is key. What interest rate are you paying? This may not be obvious from the payments you are making, so how can you tell? Let me help you here. Each loan, credit card, or mortgage account you have will likely have an app or an online account associated with it. If you can't access these, each provider will have a contact section on their website that can help you. One top tip: any credit card you have will have the department's direct phone number on the back of the card. Once you have obtained the basic details of your product, it is time to go shopping. No, not for new clothes that you don't need, new debt products. For personal loans, typically 1 to 7 years in length, here is a simple 3-step process to potentially save you thousands. 1. Request an early settlement figure from your current provider. 2. Put the early settlement figure you received into a personal loan calculator. These calculators can be found on money-saving websites like Money Saving Expert and Money Supermarket. I will put these links in the description below this video. 3. When the new monthly repayments are calculated on the personal loan calculator, are they lower than what you are currently paying? If so, and your new loan application is accepted, you could be making a considerable saving on a loan of the exact same amount. Now, you have some extra cash to buy those clothes you still don't need. No, please don't. For credit cards, so many of us do not need to pay interest on the repayments that we make. Another simple 3-step process could save you a ton of money. 1. Identify the total debt due on the credit card. 2. Punch this figure into a balance transfer credit card search. Like the personal loan section, you can find these on websites like Money Saving Expert and Money Supermarket. 3. If eligible, you could be presented with a number of credit card options that offer you 0% interest over typically a 12 to 36 month period of time. Keep an eye out for monthly minimum repayment amounts, often 1 to 3% of total debt, and fees of up to 3% for accepting the balance transfer. It goes without saying that if you find a card with 0% interest, 1% repayments, and no balance transfer fee, then you have hit the gravy train. Finally, for this step, we have mortgages. As a mortgage is typically your largest debt in life, this is where the really big savings can be made. For this reason, I wholeheartedly recommend that you look at using the services of a mortgage broker. Mortgage brokers have access to the best mortgage deals on a whole-of-market basis. What is whole-of-market? Basically, it is the widest range of mortgages you can find without limiting your options to a small section of providers. Because of this range, your mortgage advisor is more likely to find you a mortgage with a lower rate of interest. And if the rate of interest is lower, your repayments will be lower, sometimes by thousands each year. In the UK, you don't have to pay for a mortgage broker. They will receive a fee directly from the mortgage provider, which you will see on your mortgage paperwork. But how do I find a mortgage broker, I hear you ask? A website like Unbiased is a great place to start. I'll put a link in the description below. The key takeaway here is to ditch any loyalty you have ever had to a particular bank, building society, or financial institution. Loyalty is rarely rewarded in this industry, and most of the time it is penalized. Shop around. Just because you have a bank account with one provider, it does not mean you also have to have a credit card, loan, or mortgage with them. Realizing this could unlock thousands of pounds worth of savings. Step 3. Analyze utilities. When I talk about utilities, I mean electricity, gas, TV, internet, household insurance. The list goes on. Just like loans, credit cards, and mortgages, there is so much variety in utilities, and the prices can significantly differ. It is now your job to find the best price for what you need in order to save loads of money. All utilities can again be reviewed in comparison websites like Money Saving Expert, Money Supermarket, Go Compare, Compare the Market, and Confused.com. Before you leave an existing contract, however, ensure you are not in contract or you could face prohibitive exit fees. In previous years, gas and electricity prices were very competitive. However, following the global energy crisis in 2021, these competitive rates evaporated, and most of us were left on what is called the energy price cap. The energy price cap was introduced by energy regulator Ofgem in 2019, with the aim of preventing millions of households on expensive variable energy tariffs being ripped off. Because most households are on the energy price cap, there is not a lot of difference between each provider. However, it is worth checking back every few months to see if that situation has changed. Finally, when it comes to saving money on your household expenditure, don't forget about your weekly shop. Signing up for loyalty cards, like Tesco's Club Card and Sainsbury's Nectar points, can cover the cost of 1 or 2 weekly shops a year. Alongside this, going later in the day, when the yellow stickers are on reduced price items, can make a significant difference in terms of cost. Are you a stickler for an expensive brand, or could you make do with a supermarket's own version? Why not try the supermarket version, and you can always switch back if you don't like it. Remember, all these tips are meant to save you money, but they are not meant to make you miserable. The key here is to stick to your meal plan and shopping list, and not to be tempted by the Aldi middle aisle for that pair of skis you never knew you needed. Step 4. Savings. Guess what? After all the hard work you have put into cutting expenses, you now have funds to spend on a luxury sports car. I mean funds to save for a rainy day. But before we discuss savings, it's pop quiz time. Currently in the UK, what is considered a good rate of interest for an easy access savings account? A. 0.4%, B. 4%, or C. 40%. Have a think, and the answer will be revealed at the end of the video. As with everything else we have discussed today, there are plenty of options to save cash for a rainy day. This is often known as an emergency fund. Typically, an emergency fund should have 3 to 6 months' worth of your monthly expenditure in case of any, well, you guessed it, emergencies. These emergencies can include losing your job, your boiler breaking down, or your car needing an unexpected trip to the garage. It is worth reiterating that loyalty is not necessarily your friend again here. Just because your main bank account is with one institution, it does not mean that your savings account has to also be with them. Although some bank accounts include linked savings accounts, and they are definitely worth investigating. As with everything we have covered so far, there are websites for these tasks. The same ones as before, like Money Saving Expert and Money Supermarket. You can input the amount of cash you have to save, and they will tell you the interest rate you can achieve. One key for an emergency fund is easy access. If you are using the account for taking money out at short notice, unexpectedly, you do not want to be penalized for doing so. Make sure that there is no minimum saving period, or that you are not limited to a number of withdrawals over a certain period. Any penalty could negate the hard work you have put into achieving your savings rate. As well as savings accounts, cash ISAs are an attractive option for rainy day funds. The added bonus for cash ISAs is that any interest earned is not subject to tax, as the ISA wrapper protects you from it. Cash ISAs can also link in with our next step, investments. Step 5. Investments. So, you've done the hard work. You've cut your expenses, and you've saved your rainy day fund. What's left? Everything else is now a bonus for you to save for your future self. This is where stocks and shares ISAs come in. These are similar to cash ISAs, but allow you to invest in, well, you've guessed it, stocks and shares. Each year, each individual has a £20,000 limit to invest in ISAs. This is a combination of cash ISAs, stocks and shares ISAs, and lesser used ISAs like lifetime ISAs and innovative finance ISAs. We've discussed cash ISAs for your emergency fund, so now we will spend a little time talking about stocks and shares, ISAs for your investments. The reason many like to invest in stocks and shares, ISAs, rather than retain funds in cash, ISAs or bank accounts, is to protect against inflation. At the time of recording, top savings account interest rates are sitting above the rate of inflation in the UK. However, historically, long-term investments in the stock market have performed better. We are lucky in the UK, as, like everything else we have discussed today, there are plenty of options to put your stocks and shares, ISAs. Invest Engine and Trading 212 are two examples of providers I've used this year. You don't need to go gung-ho either. Investing in an ETF, or exchange-traded fund, allows you to spread your investment across the FTSE 100, the 100 largest companies in the UK, or the S&P 500, the 500 largest companies in America. Historically, these investments, while having ups and downs, have performed well when held for the long term. That is to say, don't dip into these funds when your car has broken down. That is what the emergency cash fund is for. The key with investing in a stocks and shares ISA is to invest in a fund that matches your risk appetite, and to find a fund with as low a TER as possible. The TER, or total expense ratio, is a measure of the total costs associated with managing and operating an investment fund. If you can find a TER that is lower than 0.2% at the time of recording, then you are doing just fine. Investing in the stock market can be a daunting process. If you need help with this, you should contact a financial advisor using the Unbiased website. Other than this, stocks and shares ISA websites often have managed funds guidance. However, unlike mortgage advisors, both ISA website guidance and financial advice will come at a cost to you. Right, getting back to the earlier question about savings accounts. If you answered B, 4%, then you are correct. Anything above this rate is excellent currently, and your emergency fund is in a great place. Remember, every pound saved is better than every pound earned. Why? Because unlike income, you are not taxed on the expenses you cut out. In the coming weeks, we will release videos to help you with household bills, investing, side hustles, the best AI tools, and more essential tips to help you enjoy more money monthly. Subscribe here to make sure you do not miss out.